everybody out there in Think Tank Land. Brian here with this week's episode of 52 Ways to Put Your Policy to Work. And today we're going to go over something that has come up a couple times with clients. Clients have reached out to me and asked me, hey, what should I do here? Just in speaking with friends, family members, and also a local real estate investment group I speak at and I work with. There's always the conversation point about, hey, should I pay off my mortgage faster? Should I use a 15-year mortgage? It has a lower rate than a 30-year mortgage and whatnot. And I got to tell you, there's above and beyond just the normal interest considerations and the math behind it. It's oftentimes an emotionally charged decision because it is. I mean, it's the mortgage, it's your house. At least in what I'm going to talk about here. Actually, you know what? It doesn't even need to be your house. We can be talking about this in regards to any mortgage. But oftentimes it's an emotionally charged decision. And what I'd like to do is I'd like to point out the parts that are accurate about conventional wisdom. But then in this video, you're going to see the parts, we're going to look beyond or peek behind the curtain of the messages that are told to us and really help you understand, or at least make a decision for yourself. Should you use a 15 or a 30? So check it out. Let's get to the whiteboard. So now we're over here at the virtual whiteboard component of this week's 52 Ways to Put Your Policy to Work conversation. And you're going to notice that, you know, the policy is something that can be used right next to this decision. That's why I brought it up. And it's something that's come up a few times recently in both the real estate groups and like I said, with clients. So I wanted to rip it apart, let you see it for yourself. And it kind of comes down to this thing that I'm calling the big decision. You know, should I use, and in this case, should you use a 15 or a 30-year mortgage? And I got to tell you, from the get-go, there's not going to be any right or wrong answer here. You know, you're going to be able to take a look at this, and if you only make the decision based on what you're about to see here, and you want to shut this video off after I talk about it, that's fine. You know, you're going to be able to fall right into the hands of the banks like everybody else does. But then again, it's not necessarily that it's right or wrong, because you may make a decision to use a 15-year because of where you are in life or because of cash flow or for whatever reason. But I really do think that by the end of this video, if you decide to watch past the next few moments where I validate the difference in payments and the difference in interest, if you decide to watch beyond that, I think your eyes are going to be opened. Or at least if you're a client of ours and you've already talked about this, you're going to refresh your memory on some of the things we chatted about. And also, you're going to notice this throughout. If you have adult children, if you have colleagues, if you have friends and family that are making this decision, I mean, you're probably going to recognize by the end of this talk that this is information that they need to have. They need to understand this stuff. So, because it's eye-opening. Because if we only base our decision based on interest paid, which I'm about to validate for you, you're going to find that we potentially put ourselves in a precarious position, and we can be costing ourselves tens, if not hundreds of thousands of dollars. So if you want to watch beyond the next few moments, I'm going to show you all that stuff, okay? So the big decision, should I use a 15 or 30-year mortgage? And actually, for this talk, I went to bankrate.com. Just so you know, I went to bankrate.com, and I did a little bit of homework, and you know, I got some real rates, right? I got some real rates on interest rates and stuff like that. 3.648 you're going to see on a 30-year in just a few moments, and then down here on a 15-year, 2.875. So I'm using, in this example, I'm actually using accurate rates as of fall of 2017 here as well for someone who has a good credit score, right? So if we have a $250,000 mortgage, and I wonder if I can pull this over real quick while we're doing this. I don't want to Yeah, just so you see this, where I'm getting some of these numbers from. This will be good. This will kind of validate this whole screen. 30-year on the left, 15-year on the right, $250,000 mortgage, 3.65. It was actually 3.648, and 2.875 over here on the right. 360 months, 180 months. You can see the difference in payments. 1140 or 1143 for the 30-year, and 1711 for the 15-year. And then over time too, 161,000 in interest if we take a 30-year mortgage, and only 58,000 of interest if we use a 15-year. So I'm going to pull away this because this is where I got these numbers from. And that's effectively what that's usually where this conversation stops. It's the bank turns around, or mortgage broker turns around, or your friends and family turn around and say, hey, if you can afford, if you have the cash flow for the difference here, right? $17.11 a month, $571. If you have that difference, $571 a month, and you decide that you want a 15-year mortgage, and you're happy because the bank teased you. I'm going to say the word tease because they really are teasing you with this, with what you're about to see in a little bit. The bank teased you with a lower rate here, 2.875, 2.875% as opposed to the, what was it, 3? Let me actually just make sure I get this number for us. 3.648, 3.648, right? We're going to talk about interest rates in a second. They tease you and they say, hey, if you have the cash flow, you want a lower interest rate, you want lower interest paid to us over time, here, use the 15-year mortgage. And at face value, folks look at that and they say, wow, if I can get a lower rate, if I can pay less interest over time, look at how much money I'm going to save, right? Look how much money I'm not going to pay in interest if I go ahead and lock up, because this does have a higher requirement for cash flow, lock up this 15-year mortgage. And I got to tell you off the get-go, what you're going to recognize is we think, hopefully you've heard this already, we think this decision's all about interest paid, when really we're going to come to find that it's actually more about cash flow. It's more about cash flow, and it's more about control. And conceptually, what's going to, where I can put some, shed some light on this decision is that interest is almost like a fence, and here's my little picture. Interest is almost like a fence, and really how we look at interest, the interest fence, how we look at interest is dependent on which side of the fence we stand on. Whether we earn interest, we'll look at interest one way. Usually we want interest to work for us. We want compounding to happen over time. We want to make sure that the interest is protected and just grows. Or whether we owe it. We don't like paying interest, and we want that interest rate to be lower, like we're being teased with above, which I'm going to show you today. Sometimes, if we're very knowledgeable, hey, we can stand on both sides of the fence, and when we earn interest, we can look at ways to earn interest better and more consistently and over a greater period of time. And when we owe interest, there's nothing wrong with wanting to reduce our interest rate or amount of interest paid, right? However, most of us, especially if we're enamored by the 15-year or 30-year mortgage message, which is like just looking at this interest paid, if we're only looking at it from this side of the fence where we owe and owe only, well, then we might be whipped up into the story. We might say, oh my goodness, look at the difference in the interest rate here and look at the difference in interest paid. I want a 15-year. Well, there's nothing inherently wrong with that, but I want to show you some things, right? So let's take a peek down here once we go past the interest fence and take a look at this chart. I'm going to make this a little bit bigger for us. This starts to get into a little bit of a time consideration. So on both of these charts, our timeline starts at year one. And actually over here, this is the 15-year. And over here, this is the 30-year. Right? And the red is the interest paid. Interest paid. And the red is the interest paid. Right? And the green is our principal paid. But I want you to notice two things. I want you to notice the size of the line this way, because the monthly payment on the 15-year is in the $1,700 range, whereas the monthly payment on the 30-year is under $1,200, right? And then secondly, there's a timeline issue this way. So we go this way to the right, and you notice this one ends at 15 years, and at that point, you don't have any more payments. Whereas over here, that this timeline would last all the way to 30 years. If you just conceptually, just visually look at the difference in the red areas here, there is, of course, more interest being paid in the 30-year mortgage over the course of time, right? But if you look at the size of the lines vertically, there's much more cash flow being sent to the bank in the 15-year than there is in the 30-year, right? And that's where we kind of get into the next level of the conversation, which is the control and use of your cash flow. I want you to see this right here. Let me go back up and grab those numbers real quick. Yeah, it's 1140 and 1711. So remember let's go down here. 1140, I'm just going to write this down. 1140 and 1711. What's really interesting is that when we promise to the bank and we set up a schedule and we get into a contract where we're going to send them 1711 per month for 15 years, at which time we'll have the mortgage paid off. We don't have much flexibility with that number. The reason that it's lower over 30 years is obviously because it's stretched out over a longer period of time. But what I want you to see is if you have the capability, and this isn't necessarily for everybody, that's why I said, I mean, this is definitely situationally dependent, and there's things I want you to be thinking about. But if you have the capability to send 1711 to the bank, but you could get a mortgage for 1140, and you want to look past, you want to look beyond the percentage rates here. You want to look beyond just the percentage rate. You want to know that you're being teased with this, but peek behind the curtain a little bit further. Well, if that's the case, what I want you to see is that 1711 minus 1140 keeps $560 per month in your hands that you have control and use of, right? If you're in the 15-year mortgage, you're planning on sending that to the bank. But if you're in a 30-year mortgage and you have the capability to do this cash flow, the 1711, that's $560 that you get to make a decision with, right? And if you understand like most think tankers do, like most of our clients do, like everybody that understands how to use a policy correctly, the policy itself is a place where you can actually earn interest, right? Policy is a place where you can earn interest. So what I'm going to show you here is what happens if we take that $560 per month and just use our policy as a place to catch it. Use our policy as a place where that cash flow can be caught. It can start earning guaranteed growth. It can start earning dividends. And we do that from month 1 of this example. Okay? If we start doing that, you're going to notice this blue line is actually the 30-year mortgage. This blue line is the 30-year mortgage. So we'll have accessible cash flow. This is $560 a month saved that you control, that you have use of, that's going into paid up additions, that I'm just going to assume on this line is just earning an average of 4%. What you're going to notice towards the end of this talk is that actually over time it ends up being higher than 4. But I'm just going to assume that's 4%. And what you're going to notice is that for the first 15 years, when you wouldn't have access to that extra $560 a month, for that first 15 years, we actually get our money on a compound curve. Here's the 15-year mark. Right here, right. There's the 15-year mark, right? It's not until after the 15-year mark that the person who was using a 15-year mortgage can actually start saving the entire $1711 per month at 4%. Well, I'm going to pull over a chart in a second, or numbers in a second, but I want you to notice something extremely important. Will you pay less interest over time? Will you pay less interest over time? Yes. But at the same time, is your monthly payment less? Yes, in a 30-year mortgage, right? But when you have control of that money, and we take the $560 a month here on the left and start earning and putting it in an environment where we can earn from day 1, and we have 15 years in our favor of using this before we even start saving the $1711 a month after paying off the 15-year mortgage. It actually takes all the way until year 28, 29 for the person who used the 15-year mortgage with the same exact cash flow to catch up to where we've been since day 1. So I want you to effectively look at all of this space where the person who's strategically using a 30-year mortgage has the cash flow on top of the 15-year mortgage payment, places it in a productive environment, has full access to this money to go and turn around and make other money with it. Our clients know that's why we're doing this 52-week project, right? And it's not until year 28 or 29 that the 15-year mortgage individual using that same exact cash flow catches up to us. The bank teases us with a lower interest rate, shows us that we're going to pay them less interest because they actually know that we're frustrated if we don't have a solution to where to earn interest. We think, oh, we're just going to have our money sit in a bank. We have nowhere to put it. I'd rather knock down interest. And they take advantage of that to put you in an environment where you're sending them their money back faster. Quite frankly, they're happy when they get, it's okay for them if they get less interest. It's okay for a bank if they earn less interest because they understand the principle. I got to talk about these principles here. They understand the principle of control of cash because they're controlling more of your cash as you send it to them. And they understand the principle of moving dollars. The faster they get their loan back in the 15-year mortgage, the faster they can loan again. Right? And they understand that most folks, if they don't recognize where the banks themselves stick their safe cash inside the cash value life insurance, where if the customer on the other end doesn't have a policy, doesn't have a place to put the excess cash flow that we looked at here, the $560 a month, well, then they're going to be incentivized to send that cash flow to the bank. And the bank is extremely happy to be catching that and to promote with a lower interest rate, to promote that behavior. The bank's okay promoting this behavior. Yes, they make a little bit less interest in the first 15 years, but they're lending that money out again, and they're doing it again and again and again, and they're controlling this cash flow. So let me go back to this drawing. As a matter of fact, let me do this. I did this. This is an example at 0%. This is a 30-year mortgage, the excess, that $560 a month on a 30-year mortgage, and this is the $1711 a month earnings, 0%. And you can see the break-even point still is at after year 22. You are ahead of the game with a 30-year mortgage up until year 22, even if you just have that money sit in a bank. But we know that there's better places for that, right? So what was it? I wanted to show everybody some of the numbers here that I was using to create these graphs, because I think also sharing these numbers is going to be helpful for you to see this as well. Yeah, here we go. All right, lots of, you can see this is where I got the graph from, right? But I actually want to pull up, let me see if I can delete a few of these and not mess this up here. Yeah, here we go. Okay, everybody, this should highlight it. This is another way to show that graph that I was just showing. Over here in the 30-year mortgage, and over here is a 15-year mortgage. Whoops. Right? And 560 times 12. Where's the... That's 6852 was the actual difference. 6852. 6852 divided by 12. Yeah, 571. That was the actual difference in monthly payment between the two mortgages. And effectively what we started to do was put it in an environment, a 30-year person, since they're not sending it to the bank, they put it in an environment where it can earn from day one. And quite frankly, they have access to it, right? And then the 15-year, and that adds up over time. We have access to this money. And here's the question I just want you to ask yourself. You know, whether you're looking at these numbers or whether you're looking at this chart, you know, what can you do with this cash along the way? Especially if it's an environment like it is inside the cash value account, inside a life insurance contract, where you can cycle it and not interrupt this growth, but then do something else with it. Real estate investors, other investors who know and have principles around investments and know how to make money, right? That's why we're putting this thing together, this whole project. You have access to money for the first 15 years. And quite frankly, over here, you can see this individual who used the 15-year mortgage didn't start to have that excess cash flow until after year 15. So then at that point, they're starting to save greater than what this guy on the left was saving, because now they freed up their entire principal and interest payment, that's $1711, but they haven't started it until year 16. And what you're going to notice is just even at a simple conservative estimate on what the paid up additions will earn, the person over here in the 30-year, or excuse me, the person over here in the 15-year actually doesn't exceed what the person here on the 30-year had in this side account until year 29. 29. And if for some reason you're not a client of mine or a client of Eric's yet, and you're like, well, I can do better than 4%, I'm not even talking about investing right now. I'm talking about where your savings are. Because if you reach out to us, if you're friends of a client of ours, if you want to dig a little bit deeper, ask Eric or myself. We'll help you understand how the cash value account is a place to save and you can leverage it into investments. That's what we're talking about right here, right? This is just a place for savings. And quite frankly, it's safer, listen to this, it's safer for this cash to be here than it is inside your mortgage, because at any point along the way, while you're paying down that 15-year mortgage, and I'll even go back up to this one, at any point along the way where you're paying this down and you're paying this principal into the mortgage, if something happens to your ability to create cash flow, job changes, health issues, anything like that, good luck going back to the bank and seeing how well you can adjust this $1,700 a month payment, because they're expecting next month's $1,700 a month payment. And it doesn't matter how much you've paid down your equity. Equity can change when the real estate market changes. The mortgage doesn't change, right? And if you want to go back and stick your hand back into the equity you've paid down, the mortgage principal balance you've paid down, you have to ask the mortgage company. You have to ask the bank, right? And the worst time to be asking a bank to get money back from a loan is the very same time you probably need it the most. That's just a side talk, right? Whereas at least in this world, where's it at? At least in this world, you have access to that cash all along the way. And that's why I wanted to show you this. You know, take a look right here. Take a look at these two numbers, right? In year 15. In year 15 of this example, yes, this person on the right who did a 15-year mortgage might feel fantastic that they only paid $52,000 of interest. It might feel fantastic that they, are freeing up their principal and interest payment now, but they're starting from scratch with available cash. Whereas the person over here on the left who's been taking that excess and putting it to work for them, there's a good chance that they probably invested with this money, reduced interest rates on other things, earned interest and appreciation, and made good business investments along the way. Quite frankly, by the time it gets to this point, this person, if they understand real estate or private lending, they can be using this money to make money and make those mortgage payments anyway. But that's why we continue to have these 52-week project examples. But I wanted to show you that the 30-year person has this money working for them along the way, whereas the 15-year mortgage customer has no excess cash flow using the same amount of money, 1711 and 1711, has no excess cash flow working on their in their favor, right? I mentioned to you that also that this was a little bit of a conservative estimate. I was putting at 4%, I was effectively putting the paid up addition cash flow at $399,000 by the end of 30 years. If we take a look at this, yeah, I actually put that there. Yeah, so I had kind of assumed at a conservative 4% that just the paid up addition cash flow was going to be $399 by the end of 30 years, right? But I wanted to also show you that just the paid up addition cash flow in actual policy illustrations actually far outpaces the $399 that I was assuming. So in other words, the actual return, remember every year this is credited, guaranteed growth in a dividend, it can't be lost. It's safer than a bank. It's safer than the actual mortgage where the 15-year individual wants to throw excess money towards the principal. But you can see that even my conservative investment is even more conservative than what we can expect from a policy. And then on top of that, depending on when you start, this is a 35-year-old and a 45-year-old example, you can see that there's a control of a death benefit asset on top of it, which is just adds to the greater value of this entire thing. So think tankers, I mean, some of the stuff I want you to think about as we're wrapping up this video and you're contemplating the big decision. First of all, if you have any questions about what I just went through, let me know, let Eric know. We'd be happy to help you evaluate it. And clients of ours, if you see this and you remember talking about this, or you see this and you think a family member or a friend needs to understand this stuff and understand how they can have a place to save They can have a place to save that's going to work for them over time. I mean, you got to connect this, right? You got to connect this. But overall, I mean, there's a couple main principles that I wanted to make sure we hit. It's the idea of saving first, right? And then the idea of understanding interest so that you can see it from both sides of the fence. So earning interest, not just worrying about reducing what you owe. So both sides of the fence there. And then effectively, once we get to the point where we invest with wisdom. That's basically what I want. I would love. I want one of the outcomes of our think tank to be thinking more critically about our investments, having principles to invest with, principles that we create ourselves, principles that Eric and I are going to continue to talk about over time with the think tank here, and then using those principles to gain wisdom and investing with that wisdom. So you can not only earn interest, but then you can also create cash flow. You can earn appreciation, increase your net worth, all that stuff. And then effectively peeking behind, looking at this 15 versus 30 message, knowing that there's a carrot, a tease that the banks offer with that lower rate, peeking behind the curtain, peek behind the curtain, peek behind the curtain, and see through that mainstream advice, see through that conventional advice, see through the stuff that you hear on TV and that you hear on the internet. You know, the articles that are just silliness, the articles that are like, yeah, you should have a 15-year mortgage so you don't pay all this interest. Well, hopefully by now you notice that mathematically it's true. But that is just such a short-sighted vision that here at the think tank, we're trying to help crystallize your vision, trying to help crystallize your thought process so you don't just get whipped up into the emotional piece of a mortgage if it has to do with your residence, and that you don't get enticed by the carrot, that lower interest rate that banks offer for this, because quite frankly, if you peek behind the curtain, you can see that it's in their favor. They're not doing you any favors, it's in their favor. So with all that being said, let's help you try to earn interest as opposed to pay it. Let's help you try to understand both sides of the fence. Think tankers, that's why we do what we do. I really do hope you enjoyed this week's 52-week project about the 15 versus 30-year mortgage. Have a great week, a prosperous week. Here's to your prosperity. See you next time.